All right, it is time for Mike's market update. I apologize. Missed last month due to some traveling and then late filming in this month. So we've got a lot to cover today on the macro side. So for that reason, we'll keep it a little shorter on the micro side. But for the macro side, Jerome Powell symposium quotes from August 2021. So we'll kind of go through some of his quotes there where he talks about inflation. As we know, I love to follow what the Fed is doing because that is the top of the top from a macro movement of money, which filters down to everything that happens in our economy. So we'll also check out some Fed headlines, some jobs and employment numbers, and then kind of just a discussion of what those mean and how they show up in our economy and how that then directly relates to what the Fed is doing in their decisions. We'll talk a little bit about interest rates. They've been going up. Same with 10-year treasury yields have been going up, and then the mortgage credit availability, and then some macro real estate news that kind of ties into that as well. Locally, September's numbers. So we are in October, which means we've got September's numbers to go over. We have an affordability update that we'll get into. Then more importantly, what to expect for the rest of the year and 2022, especially now that we're going to have some action coming from the Fed. So let's go ahead and get into that. The Jerome Powell's comments and the Fed. So shift in spending habits, that's what we saw through COVID, right? So as COVID shut down, we stopped buying services, we started buying goods. And so that was a shift in spending. And then that's creating inflation in durable goods. Now, annual inflation rate well below zero over the past quarter century. So when we talk about transitory inflation, how the Fed measures inflation based on the consumer price index, they're attributing a lot of it to this elevated inflation in durable goods. And they do look at that as a supply chain issue, which is not going to be a long-lived issue, but a short-lived issue, which then affects their policy when it comes to interest rates. So as usual, they're going to focus on their two mandates, maximum employment and price stability goals. And so when we look at the Fed, the tools that they use, quantitative easing, buying bonds, adding money or adding liquidity to the markets, and then interest rates. So when they're trying to affect inflation, well, then that can potentially slow down the job market, right? And so they get in this tug of war battle of they try to fight inflation, but then that hurts employment. What if they try and improve employment, then that creates inflation. So they're at odds, and it's this dance that they have to do based on their two mandates. So again, durable goods, a principal factor in the inflation well above our 2% objective. And then what I've talked about over and over again, is their new policy framework. So instead of trying to target 2% inflation, which is their objective, they're looking at trying to ensure monetary policy that hits 2% inflation over a period of time. So we've been well below 2% of inflation for a long period of time, which means they can let it run hot. The last report was 4% in inflation. So they can let it run hot. So over a period of time, it averages out to 2%. So when we talk about what their changes are going to be, we'll talk about that. So this is based on August. So unemployment down to 5.4%. It's still much too high. So they still need to find maximum employment. So they need to create policy or have monetary policy that then allows for the labor market or the employment market to improve. So they need to be accommodative in their policy, which they'll continue to do. Inflation 4.2, it's now to 4%, the latest reading since then. A cause for concern, but it's tempered by a number of factors that suggest these elevated readings are likely to prove temporary. So again, they're in that opinion that the inflation we're seeing is temporary, not long-term. So again, the way that the Fed looks at inflation is they're looking at consumer price index. They're not looking at assets. They're not looking at the stock market, real estate, Bitcoin, precious metals, those types of things. We are definitely seeing significant amount of inflation due to the excess amount of money flowing through the economy and the speed at which it is in assets. And so I think that while we can feel it real time as investors and seeing what's happening to our assets, it's completely different than what the Fed is looking at. So we need to understand that when we think about inflation. Again, narrow group of goods and services, transitory, so keywords that they continue to say. Now, that being said, so that was back in August. They met in September and they agreed that they're probably going to start tapering their bond buying. So they're currently buying $120 billion a month in bonds, 80 billion in treasuries, 40 billion in mortgage-backed securities. So they're going to start tapering that. So it's either going to happen in November or in December. So look for mid-November or December, they'll have meetings then, and then they'll decide to start tapering. It doesn't mean they're going to stop buying altogether. They're not going to just jump off a cliff, but they'll stop buying the 120 billion. And what that really matters for us is, as real estate investors, is where are they going to start pairing? Is it going to be the 80 billion in treasuries? Or is it going to be the 40 billion in mortgage-backed securities? Will be a combination of both. How they taper is going to really affect what's going to happen to yields in the bond market, which then will affect mortgage interest rates for the real estate market. So that will trickle down to the real estate market. So we'll pay attention here in the next few weeks in their next meeting minutes of what are they going to do? How are they going to do it? Because it will affect. So the meeting minutes in November and December are going to be very important for how they start paring back and what that's going to look like. Some more, so let's get into kind of jobs and employment. So I did watch Christian Kaler, one of my favorite local economists, presentation yesterday. And so I wanted to bring this slide into it. So this is the JOLTS report. It's the Job Openings Labor Turnover Survey. And what you can see is you can see our previous two recessions. There's the dot-com crash, there's the Great Recession, here's the COVID recession. And you can see what happens to jobs. Obviously, as we hit the recessions, the employment market isn't great. We see fewer jobs. Now we had that huge bounce of job availabilities, job openings after we got past that initial COVID hit. Job openings kind of leveled off a little bit. And now we've seen this huge boom in job openings. So 10.4 million job openings right now based on this survey. And that's heads and tails. It's twice the amount of jobs that we've seen for the past 20 years. And so when we look at the labor market, we'll get into non-payroll reports, which is the number of new jobs that we're adding. We're not adding jobs, even though the jobs are out there. So we'll talk a little bit about that. So initial unemployment insurance claims. So we get two job reports. Weekly, we get these unemployment insurance claims, and this is a reflection of job retention, right? So are people leaving the workforce? Are they going into unemployment? And as we can see that that's come down and down and down to the point where we've seen the lowest amount of weekly unemployment, new unemployment insurance claims since COVID hit. So employers are starting to retain employees. Now that vaccine mandates are coming out, the concerns for Delta, childcare, other issues that we're seeing in the job place, we could see this number start to go back up. But we've seen jobs be retained while we create more job openings. And then here's the non-farm payroll report. So this is the lowest amount of jobs, and this is a monthly report. This is the lowest amount of jobs that we've added since earlier on in COVID. You can see that big boom that we had kind of mid-year this year, Q2, Q3, and then we've tapered down since. And so we're not adding the jobs that we need. The jobs are out there. The employers want them. The economy is robust enough to add, to pay for those jobs, but for whatever reason, we're not hiring. Federal extended unemployment benefits have rolled off. We've expected that to bump jobs. And so that's kind of a concerning standpoint. And you got to imagine that the Fed is going to be looking at that. And so I imagine we'll hear from their November meeting minutes that they'll talk about that, about even though the market is ripe with the amount of job openings that we have, even though that we're making changes in the what's available from an unemployment funding standpoint and the special programs coming out of COVID, why are we not seeing more jobs being people going into jobs? And so that'll be a discussion that we look forward to going forward. So here's how wages work. So this is really interesting. So even pre-COVID, this is hourly earnings in the leisure and hospitality workers. And so this is kind of the lower end job creation level, where the lower end job price wage spectrum. And even prior to COVID, they were on this 4% curve. So that's what this gray line represents, is this 4% inflation, this 4% increase in wages curve. Obviously, COVID hit, the demand for those jobs declined significantly. And so the value of those jobs then declined. But since we've opened back up about a year after COVID hit, and as that hiring boom created, now we see a significant increase in wages. And if you look at that 4% trend line, we're well above that 4% trend line. And so this is what happens as we have job openings, employers needing to hire people, but people are not getting into those jobs. That puts upward pressure on wages, right? And so this is probably something that's overall good for the market. It will lead to inflation, because as cost for services sold, whether that's goods, the workers required to create goods, whether that's services, the workers required to provide those services. As employers have to pay more for those costs, then they're typically going to try and pass that on to the consumer, as long as the consumer then can't pay for it. And so that does create inflation. And so this is where we start getting away from the transitory discussion and we start looking into the long-term inflation markers. And some of those quotes that I showed earlier from some Fed presidents, they talk about that, where yes, we do believe that inflation is more on the transitory side, but we're starting to see factors that show that longer term inflation showing up. And this is an example of that. So this is good for the American worker though, right? So because we need affordability in the marketplace, we need workers to be able to afford to live, to be able to afford to spend money on goods and services, housing, healthcare, all the things that they need to survive. We need the wages to provide that type of a lifestyle and to keep our economy moving. So this is probably a good thing in the overall scheme of things. This is an interesting slide, Oregon recession comparison. So these are the past recessions that we've had and how long it takes. So if this is day one of the recession, how long does it take in years to get back up to the jobs? So in every recession, we've had a loss of jobs and then we've gotten those jobs back. 73 and 90, it only took a year to a year and a half to get those jobs back. Right now we're on pace. This is a prediction from our economists at the state of Oregon that it'll take us about 2.5 years to reach peak, get back to job level and go above the job level prior to COVID. So that puts us on trend of late 2022 to be back at the number of people with a job prior to COVID. So that's a pretty quick recovery. And it shows that we're continuing to go into a labor market improvement sections, which is good for the overall economy, right? The more jobs, the more income, the more amount of money that can flow through the economy. So this is a really, really, really good thing as far as our overall economy is concerned, and then also from a real estate market standpoint. Okay, so macro, let's talk about rates, yields, and mortgages. So rates are up to 3.14% per Freddie Mac 30-year as of today. And as you can see, that's high, right? So that's the highest it's been in quite some time. We saw rates bump up mid-February to mid-March or to April. Bond yields were going up at the same period of time. So that's the highest it's been in a while. I could have done a 3-year look back. It's low. When you start looking at 3-year, 5-year look backs, that's still a low period of time. It's just where the market needs to go, right? So as bond yields have been increasing, this next slide will show bond yields increasing, mortgage rates are going to increase as well. But this is still a healthy market from an affordability standpoint. We'll show some numbers on that as well. So here's a 1-year look back on the 10-year treasury yields. And as you can see, treasury yields have spiked recently as well. So that is exactly why we've seen our mortgage rates increase. So as of today, they're at 1.57. And with rates at 3.14, that's about a 1.6 yield spread. So you add 1.6% or 160 basis points to this yield, that gets you to 3.14. So that's also pretty right in the market of what the spread has typically been. The spread is typically 1.5 to 2%. And so mortgage interest rates are kind of tracking what they have historically. Now, if you look at where our yields are at, pretty, we go back to, this is 2021. So right after COVID, we saw a huge flock to treasuries. So big macro money got scared of the market. They need safety, so that then they go into treasuries, and that forces yield down on the treasury side. So increased demand means yields are going down, and they flocked into the treasuries. As the market improved, late 2020, early 2021, then we saw some of that short-term, some of that money that moved into treasuries, creating super ultra low yields, were short-term storage plays. So now they start pulling that money out, yields go up. And we saw interest rates go up, right? We tracked that on that last slide. Interest rates go up. This is when those bond yields were peaking as well. So right around that period of time. And then the Fed started talking about affecting inflation. So then people felt okay to get back into the bonds, which means more demand, which means yield goes back down. And then we got concerned that the Fed wasn't going to do anything about inflation. And so they moved back out of bonds. So this is typical movement that we see in the bond market, which then creates typical movement in the mortgage market. And here's a 5-year look back. So if you look at 5 years, we're extremely low, extremely low. So the question comes is, at what point do bond yields start getting back into this level, right? So this is pre-COVID levels. This is when the economy was probably as good as it's been since the Great Recession. And so that resulted in bond yields up around that 3% range. So will we get there? Now, we have a accommodative policy. We have the Fed buying mortgage-backed securities, which creates demand, not mortgage-backed securities, the Fed buying treasury bonds, which creates demand for treasury bonds, which keeps the yields lower. They're going to pull back, right? So if they start pulling back, they start tapering, then we can start seeing these yields go up as well, because less demand, unless more demand from somewhere else comes and replaces it, right? So the Fed's going to start selling bonds. Who are they going to buy it to? Or who are they going to sell to? What are those buyers going to be? How much demand will there be? Do they have to lower the price of those bonds, keeping the rates high to get people to buy them? So it'll be interesting what happens to yields in the treasury bond market, as they start to undo that asset purchasing. There is a potential big factor out there that can affect this. So we'll talk about that here in a little bit as well. Now, mortgage credit availability went back up. So again, for the month of September, credit availability went back as well. So you can see we're really hovering in this 2013, 2014, 2015 levels of mortgage credit availability. So this includes our mortgage rates that have been going up. So you can see the COVID, the big, huge drop there. Started improving. We saw the drop, right? Looking when this drop happened, right as interest rates started going back up. And then mortgage credit availability started going back up as rates went down. So we expect movement in this market, right? It's typical to see these ups and downs, but again, as long as we're hovering around this period of time, that's when real estate markets are functioning. Interest rates are at a point to still create affordability. There's still enough money flowing through the mortgage market to continue to fund loans. We've actually seen a record we're on pace for a record year in the commercial loan world. I don't want to comment on the residential world, but I think we're near record pace there as well. So funding is flowing through the mortgage market, which is essential for the real estate market. So some macro news. Evergrande. So this is a big story that started a couple months ago that I wanted to touch base on, because this is the second largest developer in China. They own a significant amount of real estate. So if we talk about what they have, 300 billion in debt, 1,300 real estate projects, 2,800 projects across 3. This is the property management side of it. They're in other industries as well. They employ 200,000 people, but say they indirectly create more than 3.8 million jobs every single year. So this is a significant employer, a significant property developer, all in China. Why does this matter? Because their bonds, the way they're funded, so they have debt, they're funded by the big banks. They have bonds to help fund some of their equity, and they are in the biggest indexes and funds that are across Asia. So as they start to lose liquidity, as their property sales are dropping, as they're not able to start, banks are not lending to buyers of their pre-sale condos, they're not able to sell those condos, buyers can't get loans for them, the value of their properties are dropping. Now they're going into potential default. So if you look at it, they're hugest developer, 300 billion in debt, and if they go into default and they supply that many jobs, what does that mean for the overall China economy? China then halted the trading of their bonds, right? So China's obviously concerned. This is one of the largest employers, one of the largest property owners. They don't want a huge run on this company. Their stock has gone down by 80% since this happened. So look at a bailout. They're kind of very similar to the 2008 Great Recession, is they're looking at some type of a bailout. Here's what's happening though. So high yield Asian bonds are seeing spikes in yield. So some of their bonds are now seeing spikes in yield, meaning money's moving out of those investments, right? So they're selling them. Now they're halted now, but yields are being, money has left that asset class. Where's that money going to go? And so when you look at who's funding these types of bonds, you look at the big banks, you look at the big hedge funds, you look at the insurance companies. So those are the type, and these are American banks, big American hedge funds. This is the big macro money, the institutional investors that are in America that also buy yields, or excuse me, buy treasury bonds. And so it is quite possible that as money can flow out, eventually flow out of this type of an investment, that they flow back into American treasuries, US treasuries, because it's the safe play. And so as this potentially happens, as the Fed's selling their interests or selling their financial assets, their treasury bonds, it's possible that demand could come out of this into the US treasury bonds as the Fed starts to sell, which would then keep yields level to potentially make yields go down, which then mortgage interest rates would stay level or potentially go down. So that might be kind of a perfect storm for the Fed to be able to kind of unwind their asset purchasing. Proposed IRA changes. So this is huge. So part of the $3.5 trillion reconciliation bill that Biden's trying to pass is part of it is infrastructure. It's not law yet, but they want to start taxing self-directed IRA, and they're creating limitations. So the bigger effect is, what do self-directed IRAs invest in? Well, they like to invest in private placement memorandums, right? So you have your IRA money, you think of the big apartment syndicators nationwide, and the amount of money that's flowed into apartments, a lot of that comes out of self-directed IRAs. So now they won't be able to invest in those private placement memorandums when they meet these parameters. They'll not be able to also own single asset LLC. So there's a lot of self-directed IRAs that what they do is they go by they start an LLC, single asset LLC, that then buys one property, and then that's how they own real estate. So this is potentially a pulling back of effective purchasing power from that type of real estate. So it's interesting what could happen from that market standpoint. So if IRAs are a large funding source for large apartment acquisitions, will that have upward pressure on cap rates, right? So we've seen significant downward pressure on cap rates, one from low bank rates, from low borrowing rates, especially at that institutional level. When you get to agency debt, you can get ridiculously good interest rates. So then that puts downward pressure on cap rates. But you're talking about the equity portion. So that's the debt portions there. The debt portion is going to remain. It's going to remain low. But the equity portion that then comes from these IRAs that are investing in private placement memorandums, that's going to pare back a little bit unless they start making changes, which they can do. Well, it's a whole nother discussion. That then potentially puts upward pressure on cap rates. So it'll be interesting to see how this plays out. One of the reasons I really don't like in retirement plans is for this. They're set up for tax benefits, but there is precedent that the government can go after them for taxing. This is one way to do it, by limiting the access of what they can invest in. And so if you're not at an employer that does matching, if you work at an employer that does like 401k matching, retirement, the revenue plan matching, that's free money, you should go after it. But as far as investing real estate or maxing out your IRAs and your retirement plans, I'd just rather buy real estate. I think it does a lot of the same things. It hedges against inflation, allows you to borrow, gives you tax benefits from a depreciation standpoint. I see that as a better way of having A, control of your money, B, you can have it now. You're not going to be penalized to get it out too early. That's just one reason why I don't like investment vehicles. And this is just an example of that. And there's past examples in the 90s when they started taxing these these retirement programs. Okay, so that's from a macro standpoint. Let's get into the local. Supply levels are continuing to go up a little bit, 1.1 months based on last month. Let's look at the end of month inventory. So inventory is what matters the most. And as you can see, as we kind of hit this tapering point mid last year, inventory typically goes down this time of year, and then we hit a floor, right? So we hit a floor in the winter, and we haven't really gone below that 2,000 residential units on the market left at the end of the month, and we've slowly gone back up, and we started to level off. We'll see where our numbers go in October, but inventory is still significantly lower from years past. And so this is a seller's market. It's just not a deep seller's market, right? So we see this when we're down around 2,000 units. That is a significantly deep seller's market. Now we're approaching 4,000, so we're like 3,500 homes now. So we're still a seller's market. Supply levels are still really low, way off historic numbers, even recent historic numbers, which are relatively low supply levels as well. So we're in a seller's market. it's just not as deep. If we look at new listings, as you can see, nothing significant here. We're not seeing that inventory is not coming from a significant amount of sellers coming on the market. We did have a strong September for sellers coming. When you compare it to the past 5 years, it's one of the best years for the amount of sellers coming to the market, but it's still so far off pace that that's not going to increase inventory levels. Now we have seen a slowdown in demand, right? So we see ridiculously high demand. Once the market corrected from that COVID drop here in 2019 or 2020, we've seen really, really strong demand in the orange and then again in the blue. And it still is strong. That's what's keeping inventory low, but it is starting to go down. This time of year, we typically do see that. So we're seeing is expected. So when we see supply levels go up, when we see inventory go up, it's expected to happen this time of year. And as demand pulls back, as we'll see, prices have gone down as well on a month-to-month comparison. Closed sales, really same scenario here. You see our COVID crunch there, and then record closed sale demand that just continued through 2020, and we're still seeing a significant amount of demand. So you look at interest rates. Interest rates are really low, even though prices are really high. Incomes are still there, especially when you think of the typical job makeup of a buyer. Our jobs at the state level are hurt more in the leisure world. Constructions come back, manufacturing's come back, retail's come back, but hospitality, leisure and hospitality is down, and those are not typically your home buyers. And so we still have a really strong demand level on the real estate side. Now, as again, this type of year, we do start to see average marketing times go up as well. So we should expect that. We kind of bottomed out there at about 20 days, which is ridiculously fast. So if your house hasn't sold in a week or 2 weeks or 3 weeks, it's not the end of the world. Okay. It's a shifting market from a supply demand standpoint. Demand is still high. It is paring back a little bit. Demand's getting smarter. We're not seeing as many bidding wars depending on what market segment you're in. And real estate's always going to be hyper local. There are some markets that are really, 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 really strong markets. There's some markets, locations that are not as strong. So understand how that should play out in your marketplace. So kind of the big thing here is month to month. So previous average sale, median sales price and average sales price are down 2.1 and 2.9% from the previous month. So September compared to August. That's common. We do see that this type of year. The year to date is significantly high. And that's what I've been talking about, that this pace cannot keep up. At some point, we need to see this month over month downward decline because this is not sustainable. And I do expect our market to flatten out, if not see declining values. So here's the affordability numbers we ran in June. Interest rates were much lower at that point. In fact, median sales price was higher at that point, kept our affordability around 116%. These are numbers that I just ran. So this is based on September's median sales price. Interest rates as of today at 3.14%, 510, obviously down from the 522, and then the yearly income that came out in April. So affordability, 115%. Anything above 100 is considered affordable, meaning their mortgage payment is less than 25% of their gross income. So it's still a market that buyers can transact in. And at the end of the day, that's what we want from a real estate market as an investor, is we want transactions to happen. We don't want a market like 2008, 2009, 2010, where transactions just were not happening. When transactions are not happening, that's a halt to the economy. That's a bad thing for real estate investors. And we're nowhere near that at this point right now. I wanted to show this. So a lot of people don't realize we had a flat market. This was a down market prior to COVID. Here's this circle that comes up. So kind of late 2017 to early 18 to late 2019, this probably circle should actually come out further to about here. We had a flat market. So you can see a trend line here from 2013 to 2018. We can see that upward trend line. Post-COVID, we have an even steeper upward trend line. But in this period of time, we had this flat line. And what was this? This was relative to when the Fed started changing their monetary policy. So that was 2016 is when they started tapering, and we started having taper tantrums. The stock market started slowing down. As you can see, our real estate market got flat here locally. That's the environment that we're going to go in. So before I talk about the environment we're going to be going into, I also want to show, so here's that decline, right? So here's the median sales price decline in September. This is really common, so, right? So we look at it, same period of time the year prior, same period of time the year prior, same period of time the year prior, same period of time the year prior. And then again, same period of time year prior. So this is a cyclical thing from a pricing standpoint that we typically see. I don't think the market's going down, but I do think that we are going to see this flat market come at some point. It's going to be reflective of what the Fed does from a macro policy standpoint. So as we talk about paring down their asset purchasing, that's going to be a less accommodative policy, which means the money will flow slower through the market and will affect the effective purchasing power of real estate. So as the effective purchasing power of real estate, interest rates will affect that, incomes obviously affect that, prices affect that, something needs to give. And so if interest rates continue to go up, prices are going to need to come down in order for affordability to come there. The other factor is we've been seeing bidding wars, a ridiculous amount of bidding wars. And so the market is in the process of calibrating itself right now. So a median sales price comes from the median price of a whole bunch of sales. But if the significant amount of those sales are people winning bidding wars, what really is market value? This comes from reported sales prices, but how many of those reported sales prices are from buyers that are paying 5, 10, 15% or offering 5, 10, 15% from a glut of buyers that were not offering that amount. And we sell enough real estate that that's what we see. You see 1 or 2 buyers that are head and shoulders above the grouping of buyers. So in my opinion, when you have 1 or 2 buyers that are head and shoulders above a group of buyers, that's not truly reflective of what market value is. Now, 1 or 2 buyers can affect a reported sales price, but 1 or 2 buyers do not make a market. Now, if you consistently have those 1 or 2 buyers time over time, sure, we can talk about that being reflective of market value. But I don't necessarily think that that's what we're seeing. When we are in exacerbated supply levels being really low, inventory levels being really low, it's a lot easier for 1 or 2 buyers to skew the market in that direction. But as our inventory levels grow, as our supply levels grow, it'll be more difficult for 1 or 2 buyers, sale over sale over sale, to affect what's being reported from median sales price standpoint. So for 2 reasons, I do expect a flat market coming. I expect it because of the Fed tapering, and then also the market getting calibrated to what real market value actually is. And that's going to be a reduction of effective purchasing power from the Fed actions will show up in the marketplace from smarter buyers not wanting to fight over each other over and over again. Now, when will it happen? I don't know. A lot of that will be relatable to when the Fed starts to act. So that's why we keep such a close eye, or I keep such a close eye on what's happening at the Fed levels, because that's going to factor the type of decisions that you make from a buy and hold standpoint, from a development standpoint. So I don't expect this really steep curve to continue. Maybe we're going to go down now in the winter, and we may speak back up in the spring of 2022. But at some point in 2022, 2023, we're going to see a flat market, if not a declining market. If we do see a declining market, I don't think it'll be significant. Again, I think that's more a reaction to calibration than actual values going down. But at some point, this trend is going to go away, and we're going to see that flat market. So that's what I'm expecting on into the future. There you go. That is Mike's market update for the month of October. And then November's numbers will be coming out in a couple of weeks. So we'll get the November video out here soon. Thanks so much, everyone. Happy investing.